said, change is inevitable. Now, change helps us, it provides us with a challenge, an opportunity to grow, to improve. Like even in our real lives, we go through so many changes. Look at yourselves. So sometimes back you used to say, thank God it's Friday, TGIF, because you were looking forward to the weekend, you're looking forward to your weekend parties, picnics, get-togethers, lot of fun. Now you guys say TGIM, thank God it's Miles, or thank God it's Monday, because over the weekends you're going to spend long hours drooling over your books, making sure you're prepared, all set to crack the CPA exams. So earlier you were looking at work-life balance, now you're looking at work-study balance. So that's a change in your lifestyle. Now in this section we're going to talk about accounting changes. So it could be a change in accounting estimate. It could be a change in accounting principle, change in reporting entity. So these are three kinds of accounting changes. We'll also talk about correction of an error which was done in the past, which you want to correct now. So let's start with talking about changes in accounting estimate. Now, a change in accounting estimate happens when you determine that an estimate that you previously used is no longer correct. So let's talk about few estimates that we use to create the financials. So how about bad debt percentage? Let's say earlier you said that the percentage of bad debts was 3% of sales. Slowly you saw that all your customers were good, all of them were paying you back on time. There were no bad debts. So now you want to reduce your bad debt percentage from 3% to 1%. That's a change in estimate. Let's talk about warranty percentage. So let's say you had an allowance for warranties for 5% earlier. Now you've improved your production process and you say the allowance for warranty should be 2%. That's again a change in estimate. How about change in useful life, salvage value of assets? You bought a car and you thought you're going to run this car for 10 years. And when you started running the car, you realized you can't run it for more than 5 years. Change in useful life. Salvage value, you thought you'll be able to sell off the car for $1,000. Now you know nobody's going to buy it even for 500. Change in salvage value. That's again a change in estimate. How about settlement of a litigation? Somebody had sued you. You thought you'll have to pay $5 million. You ended up paying 7. Again, a change in estimate. Inventory write-downs. So you had certain inventory, and inventory is valued at lower of cost or market. Now you thought you'll be able to sell the inventory above cost, so you kept the valuation of inventory at cost. Now this year you realize that the inventory has become obsolete. Nobody wants to buy it anymore. You want to write it down. The value of inventory is now below cost. It's at market. So all these are changes in estimate. Now these can happen. It's after all an estimate. How do you account for it? You account for it prospectively. So you account for it in this year and forward. So current year and future. You don't go back and change it. So this is accounted for prospectively. Now the second kind of accounting change we're going to look at is change in accounting principle. That is when you move from one GAAP method to another GAAP method. You're moving from GAAP to GAAP. Let us say you want to change the method in which you value inventory. You want to change your inventory cost flow method. So let's say you're changing from LIFO to FIFO. Now we'll talk about this when we're doing inventory. LIFO is last in, first out. FIFO is first in, first out. So you might want to change your inventory cost flow due to certain justifiable reasons. You're changing from one GAAP method to another GAAP method. That's a change in accounting principle. We'll also do this when you're doing construction contracts. Let's say you were doing the completed contract method. That's a GAAP method. And now you're going to change to percentage of completion method. That's another GAAP method. So you're moving from one GAAP method to another GAAP method. That's a change in accounting principle. How about depreciation? So let's say you were doing depreciation by double declining method, now you want to do straight line. You want to change your method of amortization, depletion. These are again change in accounting principles. But wait a minute, change in depreciation method, that sounds like a change in estimate. So what you do is, though a change in method of depreciation, amortization and depletion, all these are in reality a change in accounting principle, because you'll be moving from one GAAP method to another GAAP method. But these are treated as a change in accounting. So when you're looking at depreciation, amortization and depletion, these are change in accounting principle. Don't get confused with this. A change in useful life or salvage value, that was a change in estimate. A change in the method of depreciation, that's a change in accounting principle. Now what you do is, such changes, though they are changes in accounting principle, they are accounted for as change in estimate, because these are called changes in accounting principle, inseparable from a change in accounting estimate. So when you do a change in accounting principle, you account for it retrospectively. So let's say you're changing from LIFO to FIFO, you go back all the years that you've been working and you change from LIFO to FIFO. You're moving from completed contract to percentage of completion, again you go back for all the years you've been working and you change from completed contracts to percentage of completion, retrospectively. Now, when you're doing change in depreciation method, amortization, depletion, we don't want you to go back and change all the years with the depreciation method. We are happy if you do it from now and forward. So though it's a change in accounting principle, we will account for it as change in accounting estimate. Now, for a change in accounting principle, there is a rule of preferability. So it said that you're supposed to be changing an accounting principle. That's a big thing. You're supposed to be changing it only if the change is required by a recently issued accounting pronouncement, or you are able to justify that the use of the new accounting principle is preferable over the old accounting principle. So it must be a justifiable change in accounting principle for you to be complying with GAAP. So though LIFO is GAAP, FIFO is GAAP, there should be justification from moving from LIFO to FIFO. It's a big change. So we've looked at change in accounting estimate, change in accounting principle. Accounting estimate, prospective, now and forward. Principle, retrospective, go back and change all that you've done. The third kind of accounting change that we're going to look at today is change in reporting entity. That's basically a change in the composition of an entity. Let's say we're doing consolidated financials instead of financials for individual companies. Or there's a change in the number of companies included in these consolidated financial statements from year to year. For example, let's say a company owned 10 subsidiaries last year and they consolidated only 8 of them, because one of those 10 subsidiaries was in bankruptcy, in a bankruptcy court. Another subsidiary was under foreign control. So they consolidated 8 out of those 10 subsidiaries last year. Now this year, the subsidiary which was under bankruptcy is now out of bankruptcy. The subsidiary which was under foreign control is no longer under foreign control. So this year, they're consolidating all 10 subsidiaries. So last year, though they owned all the 10 subsidiaries, they consolidated 8. Now they're consolidating all 10. So that's a change in reporting entity, the entity that's reporting. This is again accounted for retrospectively. So you go back last year and you do your accounts assuming that you own, or rather you're consolidating all the 10 subsidiaries even last year. So this is again retrospectively. You go back, change it. Then let's look at correction of an error. Correction of an error means maybe a mistake that you had done in the past. It always happens even in our real life, right? There are some mistakes that you've done in the past. Now we want to correct it. It could also be you didn't follow GAAP earlier. Now you know what's GAAP, you know what's accounting, and you want to follow GAAP. So it could be a mistake, an error that you did in the past, or it could be that you were not following GAAP earlier. Now you want to follow GAAP. So let's say you were doing the cash basis of accounting earlier, Now today in FAR 1, I've taught you the accrual basis of accounting. So now you start following the accrual basis. That's correction of an error. Look at the difference. When I said change in accounting principle, I said you're moving from one GAAP method to another GAAP method. Here, you're moving from something that's non-GAAP to a GAAP method. So that's the difference between change in accounting principle, because you're moving from GAAP to GAAP, and a correction of an error. Treatment wise, what we do is we did retrospective for accounting principle. We do a similar treatment for error correction. We call it retroactive restatement. The keyword here is restatement. It's basically the same accounting adjustment, and we'll look at that in a moment when we come back. So we'll talk about the retrospective treatment. It's pretty similar to what we do in case of error correction, but this was something you're moving from the right method to another right method. This is something you were mistaken earlier. Now you are correcting your mistakes. Let's look at accounting changes and error corrections. So let's look at the table that we have there. Changes in accounting estimate. So that's a change of estimated financial statement amount based on new information. And you account for it, highlight prospectively. The changes in accounting principle, where you change from GAAP to GAAP, and highlight retrospective application. Changes in reporting entity, the change that results in the financials representing a different entity, and that again is highlight retrospective application. So these are the three kinds of accounting changes. Now below the table also write error in prior period. So that's correction of an error. And how do you do that? Write retroactive restatement. Now, whenever we are talking about retrospective application, it is good to remember that publicly traded companies subject to SEC requirements are required to report 2 years of balance sheets and 3 years of income statement, statement of cash flows, and stockholders' equity. But remember, GAAP does not require comparative financial statements. So right there, for non-issuers which do not report comparative financial statements, simply adjust beginning RE whenever retrospective. You've written it down right now, and we're going to discuss it in just a moment. Okay, we've seen that for changes in accounting principle and changes in reporting entity, we have to account for it retrospectively, go back and change. Even for corrections of an error, we have to restate prior periods. So let's look at the retrospective effect that we've been talking about. Retrospective effect. As I told you, restatement, it's similar to retrospective, but just that it's termed differently. So let's say we started our company way back in 2001, and we are now presenting the financials for the year 2012. So retrospective would mean going back all the way to 2001 and presenting 2001, 2002, 3, 4, 5, 6, 7, 8, 9, 2010, 2011, 2012. My God, that sounds like a Herculean task. I'm changing an accounting principle and I need to go back all those years. So what the rules require you to do is, instead of trying to present each and every year that you've done, redoing all that you've done over the last decade, what they require you is to get a cumulative effect. So what you do is, for 2001 through 2011, you calculate the cumulative effect of the accounting change. (2001) through 2011. Now this cumulative effect you use to adjust balances of assets and liabilities as of 1st Jan 2012. We are talking about presenting the financials for the year 2012. So you adjust the beginning balance. So you use it and you adjust beginning balances as of 1/1/2012, beginning of this year. So let's say if we draw this balance sheet, we've got assets, liabilities and equity. So you adjust the assets, adjust the liabilities. Now let's say if you're adjusting assets and liabilities, your balance sheet sides won't match, right? Your assets may not be equal to liabilities and equity. So the offsetting plug that goes into beginning retained earnings. So under equity you got common stock, APIC, retained earnings, accumulated OCI. So what you do is the plug or the offset for adjustments which you make to beginning assets and liabilities, all that goes into retained earnings. So you had beginning retained earnings, now you adjust that, so it could be plus or minus adjustment, it becomes adjusted beginning retained earnings. So this is the adjusted beginning retained earnings for 2012 because you're looking at the balances as of 1st Jan 2012. Now after you've done this big task, now you need to adjust and present 2012 financials. So make sure you're also using the new accounting principle in the year 2012. So then you would do adjust and present 2012. So this comes in here. So let's say we do the income statement for the year 2012 adjusted for the new accounting principle. So we have an income statement, it's on tide N, and if it's the comprehensive income statement, it will be on tide NOC. So income statement plus comprehensive income, and then we'll have the balance sheet. So this income statement, this would be for 2012. Balance sheet for 2012. So the 2012 balance sheet will have again assets, liabilities. Remember the beginning balances for 2012, they were adjusted. So you use that, do the transactions for 2012 and report the ending balances for 2012 because this was 1st Jan 2012. So if it's a calendar year company, this one would be 31st December 2012. Then we have the equity numbers. Again, you have common stock, APIC, retained earnings, accumulated OCI. Now, when you look at the retained earnings out here, this retained earnings is you have beginning retained earnings. That was the beginning retained earnings before you did any adjustment. Then you did some adjustments here. So you show them out here because you're not showing this balance sheet, guys. You're doing this as calculation, but you're not showing these balance sheet. So you do the adjustments here, plus minus adjustments. You get adjusted beginning balance, beginning retained earnings. Then you do plus net income. Where do you get this net income for? This is net income for the year. So this net income that you have in income statement flows into balance sheet. Then you have minus any dividends paid out to shareholders, that gives the ending retained earnings, the number that you have on your ending balance sheet for 2012. So basically what I'm trying to say is all the adjustment is done on the beginning retained earnings for the period presented, and for this period that you're presenting, now for this period you're following the new accounting principle. So the new period is also adjusted for any period specific effects. So cumulative effect for all the earlier periods, all that you've done in the past, period specific adjustment for the current period. Now this was when we were doing single year financial statements. Now, if you remember, I told you GAAP does not require you to present comparative financial statements. So if you're doing financial reporting for 2012, you can just present 2012 numbers. But the SEC, they require comparative financial reporting for public companies. So if you are a public company and issuer, then you need to report comparative financial statements. If you remember, we need to present balance sheet as of the end of the last 2 years. So balance sheet for this year and the balance sheet as of the end of the last year. So 2 balance sheets and 3 years of income statement, comprehensive income statement, cash flows and stockholders equity. So 2 years of balance sheet and 3 years of everything else. Basically, we are presenting 3 years of financials. So if you are doing comparative financial reporting in the year 2012, as per SEC requirements, the presentation would be for the year 2010, 2011 and 2012. 3 years of comparative financial reporting. So in this case, what you do is instead of taking the cumulative effect until 2011, we would take the cumulative effect until 2009. So there would be comparative financial statements. Let's say we're doing, so this was comparative financial statements. I'm back. When we're doing just 2012, here we're doing 2010, 2011 and 2012. So here we're doing cumulative effect of 2001 through 2009, and we adjust the beginning balance as of 1/1/2010. So guys, get the difference here. It's called, you adjust the beginning balance as of the earliest period presented. So in this case, what was the earliest period presented? We just presented 2012 numbers. In case of comparative financial reporting, the earliest period presented is 2010. What's the beginning of that earliest period presented? That's the 1st January of 2010. So we adjust balances as of 1st Jan 2010. So you adjust those balances. So let's say you're doing a balance sheet as of 1st Jan 2010, and on that balance sheet you're going to have assets, liabilities and equity. So similar to what you did here, you adjust your assets, you adjust your liabilities. The offsetting plug that goes into retained earnings. So you have APIC, retained earnings, accumulated OCI. You adjust, so you have beginning retained earnings plus minus adjustments gives you adjusted beginning retained earnings. So these are all done as of 1st Jan 2010. Here you've done it at 2012. Now after you've done this, you've done the cumulative effect. One effect for all these 9 years. It could be more than 9 years depending on how long your company has been. It could be 20 years, 30 years. Now for these 3 years that you are presenting in your comparative financial statements, you need to adjust for each and every period. So you decided that you're going to change the accounting principle in 2012, but you need to go back in 2010 and have the period specific effects for 2010. You need to do the same for 2011. So let's say we're saying you need to adjust and present. You're adjusting and presenting the years 2010, 2011 and 2012. So let us say you're going to have your income statement and your balance sheet. So you have your income statement, that's again on, tied, and O and C if it's an income statement and comprehensive statement together. So then you have income statement for 2010, 2011 and 2012. So you need to have the accounting principle changed for all the 3 years that you're presenting. So let's say you've moved from inventory valuation of LIFO to FIFO. So you're using FIFO in 2012. Make sure you're also using FIFO in 2011 and 2010 in your comparative financial statements. When you had done your 2010 and 11 financials, you had used the old method. That's fine. But when you're giving out 2012 numbers, you're trying to compare those numbers with the prior 2 years. Make sure in these comparative statements, you use the new accounting method, new accounting principle. So that was the income statement. So when you're doing the balance sheet, again, you're going to have assets, liabilities and equity. So you'll have assets for 2010, 2011 and 2012. Same thing would be for liabilities and equity. You're going to have 2010, 2011 and 2012. Under equity, you're going to have common stock, APIC, retained earnings and accumulated OCI. The retained earning adjustment that you've done is, so if you have 2010, 11 and 12, is at the beginning of 2010. So if you're looking at the 2010 retained earnings, it would be something like you're going to have beginning retained earnings plus adjustments gives you adjusted beginning retained earnings, and then you have net income for the year 2010 flowing in minus dividends for 2010, ending retained earnings for 2010, which would be beginning for 2011. Guys, the thing that we have to note here is the adjustment that is being made is as of 1st Jan 2010. So you're having adjusted beginning retained earnings as of 1st Jan 2010. Earliest period presented. So when you're doing single year financials, it was just basically the current year, because we're just presenting 1 year. Earliest year presented is the current year. In this case, you're presenting 3 years. Earliest period presented is 1st Jan 2010. Now, few things that we also have to note here when we're doing the retrospective treatment. Okay, number one, you're doing retrospective effects for just direct effects. Now, whenever you're having an accounting principle change, you would have direct effects as well as indirect effects. We're doing retrospective for direct effects. So let us say we're changing the inventory valuation method. So that would change the ending inventory numbers. That would change the income numbers in the income statement. So these are direct effects. So you have the beginning retained earning changing as of 1st Jan 2010, you might have the inventory number change here. You might have the retained earnings number change here. You might have deferred tax assets or liabilities. So if the retained earnings increase as a result of the accounting change, you would have a deferred tax liability. If the retained earnings decrease, you would have a deferred tax asset. So we'll talk about deferred taxes later, but now understand that when we're talking about direct effects, we are looking at the asset figure, the inventory figure. We are looking at the retained earnings change. We are looking at deferred tax assets and liabilities, could be deferred tax asset or liability. So these are direct effects of the change in the inventory valuation method. An indirect method effect of the change could be, let's say we are giving bonuses to our officers based on the amount of net income that we have. A change in the method of inventory would change our net income for a lot of periods. So it could change net income here, it could change net income for 2010, 11, 12, all these periods net income would change. That would change our profit sharing bonus numbers. Let's say we're paying royalties, it could change the royalty numbers. Now that is treated as an indirect effect, which is accounted for prospectively. So direct effects, we go retrospective, go back all the way back to 2001, cumulative here, adjust each period here. Indirect effects, profit sharing ratios, bonus, royalties, that we account for prospectively. So all the excess or the reduced royalties, profits that or bonuses that we had to pay out, we're going to account for it in the year 2012, now and forward. We're not going to go back for indirect effects. Okay, the second thing that I also want you to note here is, let's say we are presenting comparative 2010, 11, 12, and there's an accounting change which does not go beyond 2010. It does not go it does not affect 2001 through 2009. It only affects these periods that you're presenting. In that case, there might not be a need for you to do this. So if it does not affect 2001 through 2009, then you're not doing this. You're just having the period specific effects. There's no adjustment on the beginning retained earnings as of 1st Jan 2010, because the accounting change in this case did not affect these periods. Now, the last thing I want to mention here is that there might be some cases you really want to go back and change everything, redo all that you've done and present new accounting principles for the years that you're presenting. But there might be cases where it is impracticable for you to do all this. It might not be practical for you to calculate the cumulative effect or calculate the period specific effects. Now, in those cases, FASB or the GAAP allows you to do it prospective. So guys, I know it's getting messy. So as a rule, as a general rule, you're supposed to be doing retrospective, except if you can justify that it is impractical for you to go back and change it retrospective, in which case you would do it prospective. Now, I'll give you an example. Let's say we are moving from inventory valuation from FIFO to LIFO. Now, when we talk about LIFO, last in first out method of inventory, when we're doing inventory, we will learn that in LIFO we have a lot of inventory layers. Now, if you're moving from FIFO to LIFO, it might be impractical or not possible to rebuild inventory layers for all the past years. Now, in that case, you may go for prospective effect, not retrospective. But there are a lot of conditions to this. It's not so easy that you can say it's impractical. You have to prove that it's impractical. You have to adhere to certain conditions that GAAP has set. So once again, let me recap. Let's go on the dashboard. Let's do a recap there. So as I told you, change in accounting principle, retrospective. Except if it's a change in depreciation, amortization or depletion, which are changes in accounting principle inseparable from a change in accounting estimate, accounted for as changes in accounting estimate. Except if you can prove that it is impractical for you or not possible for you to do it retrospective, in which case again you do it prospective. Something like when you're moving from, let's say, FIFO back to LIFO. So these are two cases. First is when you're using this method, second is when it's impracticable. Also, we use retrospective treatment only for direct effects, not for indirect effects. Now, I've given you a lot of content here. Let's go in the book, highlight all this, and we'll come back, talk about error corrections. We are now looking at changes in accounting estimate which are accounted for prospectively. Now, a change in accounting estimate occurs when it is determined that the estimate previously used by the entity is incorrect. Now, what this also includes is changes in accounting principle that are inseparable from a change in estimate. So put a star there and highlight changes in depreciation, amortization and depletion methods. Do not treat as change in accounting principle, because these are changes in accounting principle inseparable from a change in estimate. Now, you have an example towards the bottom of this page. You can review the example on your own, but I want you to make quick notes on that. So where you have original estimate, write old estimate. And from years 3 through years 6, you have a bracket which says change in estimate prospectively. Highlight prospectively and write there new estimate. We are looking at changes in accounting principle which are accounted for retrospectively. Right there, gap to gap. So basically you're moving from one accounting principle to another acceptable accounting principle. So for example, it could be a change in inventory flow method. Highlight inventory. It could be a change in construction accounting method. Highlight construction accounting method. But note that changes in depreciation, amortization and depletion, though these are changes in accounting principle, they are inseparable from a change in accounting estimate and hence accounted for as changes in accounting estimate prospectively. Now let's look at the retrospective treatment that we've been talking about for changes in accounting principle. And let's use the years from the example that we saw on the board. Right, if comparative financial statements presented for 2010, 2011 and 2012. So we're presenting 3 years of comparative financial statements. First thing, use the new accounting principle in the current accounting period. So right, 2012, use new principle. Then you have take the cumulative effect of the change in accounting principle from the date the company first started business until the beginning of the first period presented. Basically, right, check for 2001 through 2009, assuming that the company started in 2001. Then you adjust the carrying values of assets and liabilities as of the beginning of the first period presented. The offsetting debit or credit is made to the beginning balance of retained earnings net of tax effect for the first period presented. So you can write there, adjust beginning BEG, assets, liabilities and retained earnings of 2010. So let's recap quickly. We said if comparative financials are presented for 2010, 11 and 12, for 2012 use the new principle. Then you go back and check for 2001 through 2009. and do all the adjustments on the beginning assets, liabilities and retained earnings as of 2010 beginning of year. Then come down on this page, you have financial statements for each prior period presented adjusted to reflect the period specific effects of applying the new accounting principle. So adjust financial statements for 2010 and 2011. We're looking at the criteria for impracticability. When it is impracticable to look at the period specific effects of the change in accounting principle. So you have the classic example of impracticability is a change in highlight inventory cost flow assumption to LIFO. It says since a cumulative effect adjustment to LIFO would require the re-establishment and recalculation of old inventory layers, it is considered impractical to rebuild those old cost layers. Therefore, this change is handled prospectively and the beginning inventory of the year of change is the first LIFO layer. Additional LIFO layers are added on from that point forward. So right there, may account for prospectively if impracticable to account for retrospectively. We have an example on the change in accounting principle, construction accounting method. Let's look at that. It says on 1st Jan 2010, Moody Construction decided to switch to the percentage of completion method in accounting for all its long-term construction contracts. Now, prior to 2010, Moody used the completed contract method for some of its contracts. Moody's effective tax rate is 30%, and for income tax purposes, Moody continues to use the completed contract method for all its contracts. Now, the contract information is as follows. So, prior to 2010, pre-tax income from percentage of completion, $700,000. Now, percentage of completion, that's the new accounting method. So, write new there. Pre-tax income from completed contract is $400,000. That's old method. So, write old. And then it says Moody does not present comparative financial statements under GAAP. So, write no comparative financial statements is equal to simply adjust beginning RE. So let's now calculate the cumulative effect adjustment as of 1st Jan 2010. So percentage of completion new should have been $700,000, but the old method that gave us $400,000 of income. So that means that retained earnings as of the beginning of 2010 should be increased by $300,000 before tax effect. Now, what you need to understand here is, you can make a note, right? If retained earnings increases, income tax would increase. So you've earned more in the past, so that increases your deferred income tax liability. We'll talk about deferred income taxes later, but for now understand that as your retained earnings would increase, naturally the tax payable on that would also increase. So on the $300,000 cumulative effect before taxes, we're looking at less 30% income tax effect, which gives a net effect of $210,000 on retained earnings. So look at the journal entry there. It says construction in progress, that goes up by $300,000 because the income from construction that goes into the construction in progress account. Now we'll talk about this when we're doing long-term construction contracts in FAR 2, but for now let's look at the credit side of the journal entry. On the credit, you have deferred income tax liability of $90,000 and retained earnings increasing by $210,000. We've looked at the three kinds of accounting changes. We've talked about changes in accounting estimate, that was prospective, now and forward. We looked at accounting principle, reporting entity, that was retrospective. We went back and we looked at what we had done in the past. We had a cumulative effect of all the prior periods, adjusted that to the beginning retained earnings of the earliest period presented. Now let's talk about error correction. That's a mistake and error that we've done in the past. What do? Again, we do a restatement which is pretty much similar to the retrospective effect that we've seen. So let's say we're presenting single year financials, we do a mistake in the year 2012. What do? Simply correct it before you present 2012 numbers, nothing much. But if you've done a mistake before 2012, let's say in 2011 or 10 or 9, then you have a cumulative effect. Adjust the beginning retained earnings as of 2012 for the prior period adjustment. Now, if you're doing comparative financial statements and you've done a mistake in any of the 3 years, let's say you're presenting 2010, 11 and 12. If you've done a mistake in 2011, make sure you correct it on the comparative financial statements. If you've done it in 2010, correct it here. If you've done a mistake before 2010, in 2009, 8 or 7 or even before that, you would have the prior period adjustment on the beginning retained earnings as of 1st Jan 2010. So that becomes the restatement, prior period adjustment, pretty much similar to the retrospective effect. Now, let's talk about self-correcting errors. So we're looking at, so in error correction, very interesting topic is self-correcting errors. So by this, I mean counterbalancing errors, errors which correct themselves automatically, magic. Think about it. Even in real life, we might have done some mistakes, some blunders in the past that nobody knows about. And then it gets overlooked, nobody cares about it, it corrects itself automatically, and right now we want to be hush, hush, hush about that. So that's like a self-correcting error, a mistake which was done in the past. You had done a mistake, but which corrected itself on its own automatically. Let's look at a few of those errors which are self-correcting in nature. Let's look at inventory errors. So when we start with the income statement, I had given you the way we calculate inventory and we look at COGS. So you had beginning inventory, then you had plus purchases during the period, give you cost of goods available for sale minus ending inventory. That give you a cost of goods sold, and then you had sales less COGS. So this number COGS, that gave you gross, and then you had less SG&A, that gives you operating income, and then you had on-tight NOC, so that was your income statement. Now let's say this is something that we have for the year 2000. We're presenting single year financials, and these are the numbers that we have for the year 2010. Let's also have numbers for 2011. Let me have some space here. 2011. So again, for 2010 we had calculated COGS, calculated gross and operating. For 2011, let's do the same thing. So beginning inventory. Trick question. What's beginning inventory for 2011? So accountants, that's the ending inventory for 2010. This number is the beginning inventory for 2011. You need to know that. Then you add purchase, gives you your cost of goods available for sale minus ending inventory for 2011. Now this one becomes the beginning for 2012. That gives you the cost of goods sold. Then you have sales less this COGS, gives you gross, less SG&A, gives you operating. Let me fit in a few numbers out here. Okay, let's say the beginning inventory as of 2010 was $5,000 and we purchased inventory worth $55,000 in the year 2010. So the cost of goods available for sale for 2010 was $60,000, and we had ending inventory of, let's say, $15,000 in 2010. That means the cost of goods sold was 45. Let's say the sales number was 100 and this was 45. The gross was 55. Let's forget about SG&A and operating for now. Let's stop at gross. So, okay, let that be. Then we have this number, $15,000 of ending inventory for 2010. That flows into 2011. So beginning inventory for 2011, that would be $15,000. And let's put the purchase for 2011 at 65. So the cost of goods available for sale, that became 80. And let's say the ending inventory for 2011 was 10. Cost of goods sold was 70. Sales was 150, let's say, cost of goods sold. This came down 70. That gave us gross of 80. Now, so far so good. Now, let's say we had 2010 numbers, 2011 numbers, and now we are in 2012. In the year 2012, we now find that we had done a mistake in the year 2010, where the ending inventory of 2010 was wrong. That ending inventory was overstated. We actually had an inventory of $10,000, but we stated 15, which was a wrong number. Think about what happened. So, if the ending inventory would have been correctly stated as 10, what would the COGS be? It would be 60 minus 10, 50, not 45. What would happen to the gross number? So if the COGS would have been 50, the gross number would have been 50, not 55. The right number would be 50, wrong number, which we actually stated, mistake, was 55. Now, think about what happened in 2011. So if 2011 ending inventory, rather, if 2010 ending inventory would have been 10, that means the 2011 beginning inventory also would have been 10, not 15. Then in that case, the cost of goods available for sale for 2011 would have been 10 plus 65. That would be 75 minus ending 10. COGS would have been 75 minus 10, 65. So in that case, what would happen? So if COGS would have been 65, gross would have been 85. A lot of numbers wrong, right? So think about it. Ending inventory was overstated. Instead of stating 10, we stated 15. Because ending inventory was overstated, COGS got understated. Instead of stating 50, we stated 45. Because COGS was understated, instead of stating 50, we stated 45. Profit got overstated. Instead of stating 50, we stated 55. So this is all that happened in 2010. Now look at the effects in 2011. Now inventory should have been, beginning inventory should have been stated at 10, but got stated at 15, overstated. When you're looking at the cost of goods sold, should have been stated at 65, got stated at 70, overstated. So because COGS was overstated, gross, which should have been 85, got stated at 80, understated. So guys, look at the impact here. Because ending inventory was overstated, COGS got understated. Because ending inventory, that's a minus to calculate COGS. Because beginning inventory got overstated, COGS got overstated, because that's a plus to calculate COGS. Because COGS got understated here, profit got overstated, because again, COGS is a minus to sales to calculate gross. Similarly here, because COGS got overstated, profit got understated. Now, this was a mistake, this was a blunder. But if you look at 2010 alone, yes, it was a blunder which is not correct. But when you put together 2010 and 2011, think about it. The profit numbers, the income numbers go to retained earnings. So let's forget all the other expenses. Let's just look at gross profit. So for 2010 plus 2011, the gross profit that actually went was 55 plus 80. That was 135, which actually went, the wrong numbers which went. 55 plus 80, the wrong numbers are 135. Now let's look at the right numbers. That would have been 50 plus 85, 135. So the right numbers are the same as what would have gone if this mistake had not happened, if we had taken 10 instead of 15. So guys, this is an example of a self-correcting errors. That's why we say inventory errors, they correct themselves in 2 years. So let us say you've done a mistake in 2010, which self-corrected itself in 2011. So 2010 plus 2011, when you put them together and you look at the number which went to retained earnings. Now I'm talking about the retained earnings as of the end of 2011. That's the same retained earnings as of the beginning of 2012. this number that I ask you to adjust. So the ending retained earnings as of 2011 is the same as the beginning for 2012. Now the effect on this retained earnings is nothing, it's a wash, no effect. Though there was a mistake, yes, there was a mistake, but no effect on the retained earnings as of the end of 2011, because in these 2 years they self-correct. So now when you're presenting 2012 numbers, though you have done a mistake in 2010, that mistake self-corrected itself in 2011. You need to do nothing in 2012. Amazing, right? Now, think about it. If you had done a mistake in the year 2011, not in the year 2010, that mistake which you've done in 2011, that has not yet corrected itself. For that, you need to do an adjustment for beginning retained earnings. That means, let's say if this year instead of 2010, if this year was 2011, and this was 2012, and you're presenting 2012, you got to know of this error. Then you need to adjust the beginning retained earnings as of 2012. But if you give them 2 years, they will self-correct, they would counterbalance each other. This was an interesting concept, pretty important. Now, let's also look at other self-correcting errors. It could be omission of accruals or deferrals. So we got some space on the board there. Let's use every inch that we have here. And this is getting really exciting. Now, let's look at omission of accruals or deferrals. Again, this would be an example of a self-correcting error. So if you have like 2010 and 2011 and we are presenting 2012, so we look at how it corrects itself automatically in these 2 years. So you have sales less COGS gives you gross, less SG&A gives you operating income. Same here, sales less COGS gives you gross, less SG&A gives you operating income. Now we've talked about accruals and deferrals when we did matching. Accruals is basically yet to receive or yet to pay. So an accrual of an expense is something like we have used this building for this year, but we haven't yet paid the rent. We'll be paying it next year or later. So yet to pay. So let us say we omit an accrual. So we have a rental accrual, SG&A, and we omit that, we forget that. What happens? SG&A comes down because we've forgotten to accrue. What will happen to operating income? It will increase. Now, because we forgot to accrue this year, next year's expense would be higher, right? Because next year we're going to be paying for this year plus next year. So next year's expense would be higher. So if next year's expense is higher, operating income next year would be lower. So if you take both these years together, it will self-correct. But if you just take 1 year together, in that case, it will not self-correct. It will take 2 years to correct itself. Similarly, let's talk about deferrals. Let's say we have paid certain expenses. We've paid insurance in advance this year, even for next year. That's a deferral, right? Received in advance for revenues and paid in advance for expenses. So we have paid insurance in advance for next year, but on the books, we have recorded all that as expense for this year. We forgot to defer. Omission of deferrals. In that case, SG&A for this year would increase. Operating income would decrease. Next year, there will be very less insurance premium, right? Because the next year's insurance is already paid. So next year's expense would be lower. Next year's income would be higher. When you put these two together, it's a wash. Self-correcting errors in retained earnings. No adjustment for the beginning retained earnings as of 2012. Again, these two were a wash. So guys, these are examples of self-correcting errors. This is an important concept when you're looking at correction of an error. Remember, when we're talking about error, mistake, that's correction of an error. When we're talking about movement from gap to gap, that was change in principle. When you're talking about movement from non-gap to gap, that's again error correction. So let's get to the book, look at correction of an error, and with this we are done with accounting changes and error corrections. We're looking at changes in reporting entity. And as we discussed, this is supposed to be accounted for retrospectively. So highlight retrospective treatment to reflect information for the new reporting entity. Correction of an error, which is actually non-GAAP to GAAP. That this is not an accounting change. So when we talked about a change in accounting principle, we moved from one GAAP method to another GAAP method. But correction of an error is non-GAAP to GAAP. However, the accounting for error corrections is similar to what we have for change in accounting principle, which was retrospective. So in case of correction of an error, there is highlight a restatement. So any error in financial statements of a prior period discovered after the financials are issued or available to be issued shall be reported as an error correction by restating the prior period financials. Now the requirements here are: number one, relating to highlight periods prior to those presented, highlight account for the cumulative effect of the correction of the error on these prior periods. And you do that by highlight adjusting the opening balances of assets and liabilities for the earliest period presented and making any highlight offsetting adjustment to the opening balance of retained earnings net of taxes for that period. And then talking about highlight prior periods presented in comparative form with the current period, financials for each individual prior period presented shall be highlight adjusted to reflect the correction of the period specific effects of the error. Of course, whenever there is a restatement, correction of an error, there are highlight certain required disclosures for the correction of an error.